Hey everybody, I wanted to just first welcome everyone to today's masterclass covering the topic of premium financing. I want to let everyone know that there will be a question and answer session at the end of the presentation. And we will hold all questions to the end. Feel free to ask you have throughout. It'll probably be a lot. This is a pretty good topic that goes into the details. So ask any questions you have as we go. We'll hold them to the end, and at the end we'll have the Q&A session and work to get through as many. Also want to let everybody know we're recording the presentation. We will be sending this recording out to everyone that registered here within the next day or so. You'll get that. So all right. So today we are very grateful to have Eric with us. He's going to be sharing his knowledge. Eric is a premium finance wizard and a frequent masterclass presenter like this. He's a noted thought leader and lecturer on the topic of premium finance life insurance. He consults with the top carriers and very involved with it. He's going to take us on a deep dive into the complicated yet lucrative topic of premium financing. And it is a topic that can get bit into the weeds here, but the people that are doing it successfully are making because they've taken the time. So Eric's going to talk to you today about that and some of the things you can do to be well on your way to mastering the craft and make more money with premium financing. So I'm going to hand it off to you now. Take it away.
Great. Well, thank you so much, Justin. I appreciate it. And again, thanks to everybody that have taken some time out this morning to learn a bit about this topic. And the way I set up today's presentation is to actually walk through a case study. It's one that we've recently done. And the reason I chose this case study is because it actually, I think, demonstrates two things. Number one, how premium finance can be worked into a common scenario most of you have likely come across in your careers, and also to display how you don't have to be an expert yourself. In fact, you don't have to have ever done a case before using premium finance in order to get one done here with Brokers Alliance. And so I'm going to talk a little bit about the value that we bring to the table and how you can create these opportunities. I'm going to walk through this case study. And as Justin mentioned, if there's any questions throughout this presentation, do not hesitate to send those through. We'll make sure we get them answered. And as I go through this presentation, I'll kind of unwrap the technicalities of premium finance, but I know that there will be some questions perhaps about the lenders and how it works. Justin mentioned, we'll get to those at the end here. But again, I think it's helpful to talk about a real life case and kind of unpackage how we approach this thing and turn it into a premium finance. I think everybody on the call understands that when you get into a premium finance realm, you're talking about significant premiums and therefore significant commissions. So it is a very opportunity, but there's one thing in mind, and that's premium financing is a means to pay for a policy. It's not a version of a policy, and it probably, I should say, arguably isn't an approach necessarily that you start with when you're talking to a client about life insurance. The most important thing, we have to establish a need for the life insurance first. The client has to understand that they've got to get that policy, and then we introduce as a way to pay for it. When we follow that course of action, we tend to have a very high success ratio. Okay, so always keep that in mind. Premium finance is a means to fund. It's not to start with. If you start with premium financing, you'll find yourself most likely not closing the deal. So let's talk a little bit first about Brokers Alliance. Now, with premium finance, there's two types of entities you can work with. You can either have a direct banking relationship or go through an aggregator, which is like a third party. All they do is manage and handle the ongoing process for premium financing, and then typically your case gets split. You're giving commission up to the aggregator, potentially up to another organization in order to get the transaction complete, but you'll have that person there who's going to focus on it for you. The other way to go about it is directly through a BGA like Brokers Alliance, who has an in-house team set up to do premium financing, and that's what we have here at Brokers Alliance. And so what really makes us different is, number one, we're a brokerage general agency. We focus on the underwriting, the whole process of life insurance from soup to nuts. And so when working through premium finance cases, it's nice to have everything consolidated in-house. It just makes it a little bit more efficient. It creates I think, a better accuracy and a better communication flow for your client, for you, for the bank, for the insurance company, and everybody involved. What makes Brokers Alliance different than the other BGAs out there is that we not only do the case evaluation, meaning that we're going to analyze this thing and come up with an approach, a pre-sale and a post-sale approach for you. We also provide point of sale support. The case study that I'm going to talk about today is one that I handled side by side with the agent from the entire process from start to finish. And that level of point of sale support depends on you. If you've been doing this type of business a long time, you may not need a whole lot of support. Or if it's your first case, it might be something that you want us to be by your side for the entire way. So we offer that point of sale support in a variety of different ways. And we don't charge you half your case or a case split of 50% in order to do so. I'll talk a little bit more about case splits later, but I think something really important to note here is if we actually get fully involved at point of sale, I'm jumping on an airplane, I'm going out there and helping you close the deal. At most, you're looking at maybe 15% case split. The industry average is between 20 and 50%. So we're very much a strong entity to work with that allows you to maximize your profit in the transaction. Banking relationships and case design is something that we handle. So it's interesting. I've been doing this a long time, and I've been doing premium financing since 2007, back when it was non-recourse, and it's evolved quite a bit over the years. And one thing that I find fascinating in this business is that a lot of organizations out there will present themselves like they have a secret weapon or a magic arrow in order to get a deal done better than anybody else. And that's simply not the case. I know every program that's in the market. I've talked to just about every lender out there. And what it really truly boils down to is case design, understanding how these policies work, how to design them so they maximize the value when you're doing a transaction like premium finance, and having true long-term valuable banking relationships so that you can create a lower spread or a better interest rate environment for your clients based on the total relationship that Brokers Alliance has created with the institution. So, there's like I said, there's no magic to premium finance. There's not one organization that has a better mousetrap, so to speak. It really boils down to banking relationships and understanding of how this works and understanding of how to design this so that the client will understand the process and will want to move along with the transaction. So that's really the secret sauce there, and that's something that I've spent over 10 years putting together here at Brokers Alliance and maintaining for us is a valued case design, a presentation that makes sense, and banking relationships that make sure that we are getting that client the absolute best deal. And the last part here that really makes us different is the underwriting, and I'll talk about it here in this case too, but we're talking about mathematics, pure and simple, right? So the higher the risk class, if we're dealing with table rates or standards, then the harder it is for us to make the numbers crunch and to exit this transaction in a way that doesn't require the policy to max out its performance every single year. You don't want to enter into a situation where the stars, the moon, and the sun got to line up, because it's not going to happen. And with these types of transactions, you're dealing with clients that are likely your top, your most prized, and we don't want to make mistakes or create expectations that can come to fruition. So underwriting expertise really comes into play there, because we're able to, on the brokerage side, leverage what we do each and every day to get standards or preferreds when the carriers were originally coming to the table with a much worse rate class. And that's really important. So we're not just doing the financing side, we're not just doing the case design, we're underwriting this thing and making sure that we're maximizing the value from the insurance company standpoint too. So this is the whole package that you get here at Brokers Alliance, and I thought it'd be important for us to start out with that so you know who you're talking to and what the real value is when doing a transaction like this with us. So I want to talk about a case here, and this is something that happened late last year, and it took us a few months to wrap up the entire transaction. I'll talk a little bit about that here in a minute too, but it was really quite a simple situation. We had a husband and wife, both 47 years old, and they currently had $1.5 million of term insurance coverage with AIG, and they've had it for 5 years. So the agent that we were working with is someone that I've known for many, many years. He's worked for Brokers Alliance for over 15 years. And what was interesting is this agent's marketplace is middle America for the most part. He sells a lot of term insurance, works a lot of internet leads, He does his GULs, and he does a good job of doing conversions when appropriate for these clients. But he had never really ventured into the advanced markets realm and really kind of stayed in that middle marketplace. But what's interesting is each and every one of you on the phone, whether you're in the affluent market, the middle market, or even some of the less affluent markets out there, there's probably at least one client that would fit the fold for premium finance. And that's why, again, I chose this case study because I thought it was really interesting how this thing kind of came to be. So here we go. We got husband and wife. They got a $1.5 million term policy each. And originally, when they bought the insurance, it was sufficient for the death benefit amount for the current value of their portfolio, but things had significantly changed over time. And what's funny is this case actually came to my attention because I look at reports all day here at Brokers Alliance, and anytime I see premiums over $10,000, I roll up my sleeves and dig in and make sure that we're not missing out on an opportunity. And I did so with this case. And what I did is I had our marketer go back and talk to our agent, and we gave him a call and said, hey, tell us a little bit more about this client. What's their current net worth and what's their financial scenario today? And he was able to get some information for us, and we found out that this individual has grown his portfolio with his spouse to over $36 million. And the portfolio was primarily comprised of real estate. And within that real estate, he had about $12 million of debt. So he had $12 million in outstanding loans on this portfolio. A lot of it was commercial real estate, and it was income producing. So two things jumped out at me immediately. Number one is we have a significant insurance need because if God forbid one of the two of them died and they have 50% ownership in this portfolio, then the other one's going to have to make up the debt there on that portfolio. They're going to have to continue to pay off the banks. And so we had a debt coverage need that we immediately identified. And in looking at this case, with the portfolio being duly owned, we also saw the opportunity to create some future income for them so that they could either pay off the debt, and I'll cover that here in a minute, or they could, increase their portfolio with future cash values. And so we saw some need there for cash value life insurance in addition to the death benefit. And so we have a debt plus income type scenario that we identified immediately, and we didn't even have to talk to the client yet. This was just in some basic conversation. We knew that they were interested in a term conversion, so they're already thinking about spending a little bit more money, but we identified something bigger here. So with the term ending well before the debt will be gone, they wanted to convert. However, the coverage was well below the actual need. Again, it was only $1.5 million at the time. So we had a few challenges in the process of taking this deep dive, and we wanted to make sure that we were addressing these three challenges. So we had a cash flow issue, an underwriting issue, and a non-guarantee issue. So as we started exploring purchasing additional coverage, we began a conversation with the client about what their real needs were. And it was as simple as I got on a conference call with the agent and their client, introduced myself as a partner of the agents. We work back at their home office, and we focus on advanced planning techniques. And we started talking to the clients about the fact that they needed more coverage, and they were open to it. They understood that, yeah, there's a significant debt. It'd be nice to supplement some of this income coming off the real estate, so they had some diversity, and they understood the purpose of the insurance. But in order to increase that coverage, they knew that they would have to have a significant increase in the out-of-pocket expense. And right now, in their minds, they're both 47 years old. They're in an acquisition phase. They're going to continue to buy commercial and residential real estate. So cash flow is very important to them. And so their initial hesitation on buying additional coverage was that they simply didn't want to shell out the dollars to do so because they wanted to keep their cash as close to hand as they could to buy future real estate properties. We also faced another issue there with underwriting. So initially, when we got both of those clients issued at $1.5 million on term insurance, they were both preferred plus health risks. Well, something had changed with the spouse, the female, and she was actually coming in at a table 4 when we did some initial analysis with our in-house underwriters, and we recognized immediately that, in order for us to buy more coverage, we couldn't simply do a conversion because she would be underinsured. To buy the additional amounts that we were hoping to get for her, we had to go to work on the underwriting side, and we were able to actually evaluate this case and get the table 4 up to a standard non-tobacco. But even at standard, we had a significant jump in premiums. And so it kind of backflowed into the original problem, which is we wanted to focus on maintaining an out-of-pocket expense that was tolerable for them, still allow them to accomplish our acquisition goals in this early phase of life, and offset the fact that we're going to pay a little bit more premium for her because she is now a standard. The other thing is there were some non-guarantees. You know, as a solution, we intended to present IUL for premium control and to introduce premium finance, but IULs have a lot of moving parts. And the clients understood term insurance, and they were understanding the guaranteed universal life insurance and the guarantees that it provides based on the premium schedule that was originally presented to them. So their initial questions were, well, what are the guarantees in the IUL, and or how does this work? And so we knew that we faced an education challenge in this process. So three things again: we had to make sure that we were paying attention to the cash flow. We had to make sure that we were focused on underwriting to maximize the health risks and keep the costs down. And we had to make sure that we provided an educational background on how IULs work before we even got into the moving parts of premium finance. And the reason I'm showing you guys this process and this flow and this presentation today is because this is how we need to approach every one of these cases. When you take the client down the path of identifying the problems, the needs, and then you provide the support and education behind it, they are much more likely to agree with the transaction and to understand it. And it's really important with premium finance that they understand it, because they have to deal with this transaction alongside you and us every single year when we go through the renewal process. So this is really a big part of it, is the education. So let's talk about the solution that we came up with. So we determined that we needed about $7.5 million of coverage on both of them. So each of them needed about $7.5 million. That, after we net our death benefit after the finance transaction, would have covered the $12 million of debt. It also provided a significant cash value that I'll talk about here in a second to address the future income and or acquisition needs or wants that these clients had. So the coverage, again, was going to cover that real estate debt upon early death. Cash values would grow to an amount that was significant enough to provide that additional income. Our solution to the cash flow problem was to introduce the premium finance, and what we did is we created a cap for our interest rate. We wanted to make sure that the out-of-pocket interest on the transaction itself didn't get out of hand, and it stayed within a relatively reasonable amount of money that they were willing to spend each year on life insurance. And in order to do that, we made sure that we ran a variety of different scenarios and different insurance companies to choose an IUL product that allowed us to cap that interest rate, roll the difference of the interest into the principal of the loan, and to still exit this premium finance transaction in years 15 or 16, so that we kept the time horizon short, we were able to accomplish the goals, and still keep that cash flow under control. And I'll show you exactly what this looks like here in just a moment. Now, of course, every time you cap an interest rate and you roll additional monies into the principal of a loan, you're creating a larger loan value or outstanding loan balance. And these loans have to be 100% collateralized. I'll show you what this looks like in a second, but just bear in mind, you have to be 100% collateralized. And so cash value is always the primary collateral we use with a premium finance transaction. We're actually collaterally assigning the policy to the lender during the time that the loan is in place. And so we had to make sure that we were able to cover the shortfall of collateral, because it wasn't just the shortage of the premiums that we were borrowing, but it was also the additional interest that we're rolling into the loan, because we wanted to keep their out-of-pocket expense under control. So in this particular situation, we had a personal financial statement. We looked at it, and this individual had some securities, non-qualified securities, and they had some cash that they could put on deposit in a bank CD. So we actually showed them a combination of using securities and cash to secure the loan. And again, I'll show you what that looks like. But in doing so, we were able to, again, address that very first need, which is making sure that we weren't hurting their cash flow. Underwriting an IUL. So in the premium finance transaction, like I said, one of the clients had a table rating. So we went to Global Atlantic, and I'll talk a little bit about some carriers here when we address questions at the end. But in this particular scenario, Global Atlantic was a great solution for them. And we worked closely with Global to get this client to a standard non-tobacco. We really took a deep dive on this case, tore it apart, found some health credits, and we were able to get them to be comfortable at standard. And again, with premium financing, every dollar matters. And so a table rating really truly creates a higher multiplier on that cost of insurance. And that was simply something we didn't want to work with. So we were able to work really hard to get it to standard. And the second part of it was educating about IUL. So we worked closely with the agent and the client to look at how IULs work, the rate of return probabilities, and we walk through several different designs to make them comfortable with the policy type. So when we do this, we actually run more than one illustration. We show them, a strong performance, a mid-rate performance, and then we actually show them right off the bat the minimum guaranteed performance of an IUL, because we want the clients to understand the risk that's involved with these policies. But we gauge them in this process. As you're talking to a client, especially with some of the questionnaires that we've designed here, we really truly know how to ask questions in a way that helps the client show you just how involved or how much understanding they have about the market, or about how interest rates work, or compounding interest, all those sort of basics that we take for granted as financial professionals. We really go through a process to try to gauge the client's understanding, because that's going to tell us just how deep we need to go with regard to how an IUL works. And so the second part of the solution was getting a standard, and then focusing on a conference call that I had with the client and the agent to talk about how IULs work. We did a screen share, and they were able to walk through these illustrations and get a good understanding of the value of a product like an index universal life insurance. So we were able to check off the initial boxes, and it took us to the point where we started getting into case design and the collateral and how we're going to specifically address it. So what you're seeing here on the screen right now is an actual spreadsheet that we put together for these clients. And sometimes the spreadsheets can vary a little bit. We can include internal rate of return, or we can include income coming out of the policies, things like that. But really the purpose of the spreadsheet is to consolidate the story and take them down the timeline of how this all unfolds and how all the numbers kind of come together. So what you're looking at here is an individual age 47. We capped an interest at $50,000 per year. And I'll talk about the premiums on the GUL here in a minute, and you'll see how, why we determined that this was a good number for the client. And then we did a variety of different design scenarios to make sure that by capping the interest payment at $50,000, we were still able to exit the loan, keep the collateral under control, and net the right amount of death benefit. Exiting in year 15 is always a goal of ours. We try to make sure that we exit by at least year 15. And for those of you that are more studied on IULs and illustrations, you'll know that AG 49, that actuarial guideline 49, that came about several years ago, forced us to change the way that we show arbitrage in these illustrations. And so if I know that I can exit in today's illustration world by year 15, that tells me that in real life, I can probably exit the transaction a lot sooner, because there's a good probability that we're going to have greater than 100 basis points of positive arbitrage in several of the years that we have leading up to the point of exit. So most illustrations you see from us, you're going to see us exiting these loans around year 15 if we can get it done. But in the back of your mind that we could probably exit a lot sooner, keeping the cost, again, even further under control for the client in a real-world performance scenario. So what you see here is a reflection of a policy that we designed using a 10-pay strategy. And I'm just going to talk about the male here because the female's numbers obviously looked a little bit better. But at age 47, he was a preferred, premier preferred non-tobacco. We ran it at a $7.5 million death benefit. We used an increasing death benefit. And we can talk a little bit more about these designs here later on. But what we did is we shoved all the premium in the contract with a max non-MEC premium for 10 years, and it came to $375,600 for him. And in doing so, keep in mind, we're borrowing these amounts every single year. We're applying an interest rate charge to this particular premium that we're borrowing every year to determine what the interest is going to be from the bank, and that's what you see here in column 4. So what we did is we matched that interest, and then, as I said, we capped it off at $50,000. So the first couple of years, the client's going to pay under that. They're 18, then 37, and then once they hit that higher number, we level it off. And the difference between these two is what goes into the actual lender loan, the actual amount of money that we have as a balance there with the lender. The interest rate side, you'll see is actually quite aggressive. When I talk about interest rates, quite often that seems to be a point where everybody wants to kind of roll their sleeves up and debate, what's the best way to display interest. So I go about it two ways. Number one, I talk to these banks every single day, so I know where LIBOR 30-day 1 year is, or some banks we use are using 4-week T-bills as their underlying rate. Those are always the variable components here. The spread is what's typically fixed, and so we'll negotiate with the bank to fix the spread over 5 years or 7 years. And I'll talk interest rates kind of future forward here towards the end of the presentation today, but just bear in mind that the first year rate that I show is usually something that I know I can at least be within the ballpark of when we set these clients up. And then if you subscribe to some of these rate indicators out there, PIMCO's being a big one, you know, the forward-looking yield curve right now on LIBOR is flat. So what they're actually projecting in the banking world is that the next 6 to 7 years, we're going to be in a relatively flat interest rate environment. So that's a really good thing for us in terms of predictability on these policies, and it means that there's a high probability anyway that we're out of the interest rate hikes that we saw in the last 18 months or so, and that when we project these interest rates, we're being conservative, because if PIMCO's out there telling everybody that it's going to be flat, and most banking institutions are subscribing to that same notion, then when I stress this thing up 25 basis points a year, I'm being extremely aggressive in what the actual interest rate performance likely is going to be. And sometimes I'll throw in a little tweak in there, like here you'll see the interest rate dropped once it got to almost 6%, because I'm going to assume that at some point, if I reach an interest rate peak in my mind, which right now is about 6%, I'm likely going to refinance this transaction for the client. So for me, interest rates are a subject that you have to be very knowledgeable in when you're illustrating this stuff. But most importantly, we got to make the client understand why we're being aggressive on our interest rates in these illustrations, and how that compares to what the actual banking world is talking about. Again, projecting that next 6 or 7 years, we're going to have a flat yield curve. So if I know I can get this thing to work with an aggressive interest rate, then again, we know it's going to work even better with a flat yield curve. And I'll talk more about interest rates here in just a bit, but I think that's important to know. So we see the actual out-of-pocket, total cumulative out-of-pocket from the client here in this column 9, and that's really what we focus on in the point of sale. Is like, hey, look, all these numbers are all well and good. As you can see, we're getting a considerable amount of premium into this policy for you. But what you need to really focus on, Mr. or Mrs. Client, is that your actual out-of-pocket is going to be something that we've got under control for you, and it's not going to be as significant as it would seem had you bought this policy just yourself out of pocket. Cash value is in this illustration because we want to show them that the cash value is the primary component of this collateral, and we see what the collateral requirement is going to be, which creates a shortfall here in red that is represented in column 12. And this is what we have the client post. Again, either marketable securities discounted typically at 50%, or cash equivalents like bank deposit in a CD or a money market account, or a pledge of an existing bank. When we look at a client's portfolio, what's interesting today is I see a lot of clients have gone to cash or bonds or treasuries in a portion of their portfolio. Typically, we get a better discounting rate depending on the bank that we're dealing with when looking at those types of securities. And so they'll actually evaluate the brokerage accounts and show us a breakdown and determine which of those particular securities would make the most sense in terms of the collateral. And it's typically stuff that the client doesn't intend on touching. So that's made up here in this column. And as you can see, based on my projections, the high point was only about $275,000 plus or minus. So it wasn't a huge number in the grand scheme of things, especially when talking to a client that's got a couple $1 million in a brokerage account and $36 million of real estate. So he had no problem understanding the pledging of this collateral. What's really nice is if your client's in the real estate game at all, they get the leverage. I mean, it's what they deal with every single day. So to them, this is no different than pledging collateral for any other type of loan or pledging equity or anything along those lines. And so they tend to understand it quite well. Your average client out there is going to get it. The ones that don't, that's fine. We walk through the importance of securing the loan fully and the advantages that they're going to face when they secure their loans fully. In this particular example, we didn't take any income out of the policy in the first 15 years, which you see on this illustration. But if we went further down in this illustration, you would see that we actually created some income out of the policy for them once we exited the loan. And I'll talk more about that again here in a minute. We also then focus on the last part of the illustration on what the death benefit of the policy is and what the net death benefit is, assuming that they died somewhere in this first 15 years. The policy's death benefit would actually be what pays the bank back, not the cash value exit, because it's a higher number. So this is actually what the client would be netting in the years that were involved in the premium finance transaction. So as you can see, we designed it in such a way to make sure we stayed as close to that 7.5 or exceeded that 7.5 million each and every single year. And that's a big part of this. It's a balancing act. So when we're behind the scenes putting these illustrations together, it's not a wham, bam, thank you, ma'am type process. It actually takes us a couple of hours to really sit down and tweak these illustrations in order to accomplish the goals that we're set out to accomplish. So if it's a death benefit oriented sale, we've got to make sure we're netting the right amount of death benefit. If it's a combination of cash value and death benefit, we've got to create a balance between the two and make sure it's addressing all the issues that the client wants, because if they don't see it addressing those issues, they're not going to buy it. So this is the mess of numbers, so to speak, that we start with. But again, we walk through each column one at a time, typically over the phone or live in a video conference, or even face to face if it's going to be beneficial for the client that way. Let's talk about the details of this then. So what I did is I went to the banks out there, and with Brokers Alliance, we have a relationship with a number of different banks. Some are regional, some are national. Some are banks that you've all heard of in the premium finance world, like Wintrust, because they do this every single day. I always make sure that I'm shopping with them. But also we have a lot of other organizations that we work with. We've done transactions with large institutions and small. So it's across the board. And the reason I keep such a range of banking relationships is because truly one size does not fit all in these transactions. Sometimes we talk to clients that have low net worth but high income. Sometimes we talk to clients that have high net worth and no more income because they're retired. I mean, everybody's a little bit different. So we want to make sure we're negotiating the best deal for the clients. Typically with a relationship bank, like a small regional bank or something that's got a footprint maybe in a handful of states, we can get a lower interest rate in exchange for some relationship type transactions, i.e. they make a deposit at the bank, or they work with that bank for commercial real estate loans, or perhaps they're already banking with them, and we've approached it in all those different ways. And so having that range is really important for us at Brokers Alliance to make sure we're always getting the best deal for the client, and that we're working with banks or institutions that have done premium finance before. The worst thing that we've seen is a bank that has no clue how to do this stuff, because typically they end up charging too much because they're worried about their risks and they don't understand how life insurance works. And so, I've had agents bring banks to me before, and after talking with those banks, I've encouraged them to think about something else, regardless if the client had a relationship or not, just because they're going to make it difficult for you. And we don't want this to be difficult. We need this process to be smooth because there's a lot of moving parts, and you don't want the client to be discouraged. In this particular example, I wasn't able to negotiate an interest rate spread 75 basis points lower than the average out there in the marketplace for a premium this size. A lot of times you'll hear that an organization is borrowing large amounts of premium up front for interest rate breaks, meaning that if the annual premium is only a few $100,000 a year, they'll borrow the first 3 or 4 years all up front in order to get a lower spread on that money, and then they park it in like a PDA account and have it fund the policy. The challenge there is that you've essentially cost your client more interest than need be. And if we're carrying a larger load, it's going to translate with compounded interest down the road, so to speak. So we have to make sure that if we're really doing a large borrow up front to fund the policy over time, that it pencils out to make sense. The reality is, if you have enough banking relationships, you can get those same interest rates and you don't have to borrow all the money up front, which is a lot of times what I'm always trying to accomplish. I want to get a low spread regardless of what the premium is. So we've been able to get better rates than some of our competitors out there simply based on the value of the relationships that we have with the banks versus how much premium that we're putting into these policies. So that's a big deal, that we're saving the client a lot of money by shaving 75 basis points off the rate. We also negotiated a cap to the interest payment, allowing for us to keep control of the out-of-pocket despite the potential interest rate increases. This one was a LIBOR deal, but like I said, we've also used some treasury rates, and we know that those are the variable components. So if the spread is fixed and we got a really low spread, we still have the possibility of the rate going up over time. So we back test it with different jumps in the interest rates to make sure that the cap that we're negotiating with the bank is something that's going to work long-term mathematically for the client. And in this case, $50,000 was a number that worked very well. We worked on a creative combination of initial collateral and future collateral. Like I said, we were using their brokerage accounts with some deposits. And then this particular client had a new building that was kicking off some additional revenue, and they were going to start parking some additional cash on the side to over-collateralize, just to be conservative. And I like that approach because it saves us hard conversations down the road. It doesn't necessarily always have to go that way, but this client was set up in a particular scenario to be able to accomplish that. And we did a simple and customized illustration to help explain these moving parts to the client, which was really important. They had a lot of questions. We spent several phone calls together, and then I actually flew out to meet the clients towards the end of the transaction. So, like I said, it took us a few months to get the deal done. That's including all underwriting and all the meetings that we had to make sure they understood the illustrations and all the moving parts involved here. So if we look at this thing and what we ultimately accomplished, it was, again, starting out as a GUL versus an IUL. When we look at finance versus non-finance, in the first year, a GUL premium for $7.5 million of coverage would have been $52,000 a year. The actual out-of-pocket the client faced with premium finance was an $18,000 interest payment. By year 10, the total cumulative premiums in that GUL, and this is us using Anaco's GUL, one of the cheapest out there, solved to age 105, it was $523,000. Well, the cumulative out-of-pocket interest expense on the premium finance transaction was significantly lower. It's $455,000. By life expectancy, the client would have had to put $2.1 million of premium into the GUL. We were at $655,000 by life expectancy, all in out-of-pocket in the form of that capped interest payment. And as you can see, there is a significant difference in what this client had to liquidate in terms of their assets in order to pay for this thing. And let's put that in perspective for a minute. Nearly $1.5 million plus or minus that they left in their investment accounts or their brokerage accounts earning interest. And whether or not we pledge those accounts for collateral is neither here nor there, because if we're pledging an account for collateral, it's still sitting there earning interest. So as you can imagine, at age 88, 41 years after we bought this policy for the client, they were able to keep $1.5 million at play, earning interest on top of interest, which obviously can compute to a very large number for them. So we saved them a tremendous amount of money in the way that we designed this thing, having them pay for interest versus pay for premium. We talked about debt consolidation options. So we assumed, and we answered this question because the client asked it, what happens if they don't die? They still want to pay this debt off. They don't want to carry this debt forever. Is there a way to leverage this policy in order to do so that would actually save them some of their own cash out of pocket? And the answer is absolutely there is. By year 20, the cash value net of the premium finance loan was $2.2 million. As you know, if we borrow against this money, we can actually turn that 2.2 into a much more significant vehicle. So we're able to pull several $100,000 a year out of this policy via a policy loan and use that to start paying down some of this debt. The death benefit at that time was 9.7, so it was more than they actually originally needed because we're using increasing death benefits. And we were able to not only knock out the need for the life insurance, but we had a nice pool of cash there by the time they were in their retirement years. If we flash forward 30 years, the clients are 77 years old. There's over $7 million of cash surrender value. They could buy more buildings. They can pay off all of their debt. They're passing on this real estate portfolio to their children. They could pass it completely debt-free, or they could buy more real estate. There was just a lot of opportunity for them once they got through that debt period to either pay it off faster or have some means beyond their own pile of cash in order to create some future opportunities for acquisition or debt restructuring. So lots of cash value and very significant death benefit. The longer these IULs go, if you've seen these illustrations, you know this, by the time you get into your late 70s, 80s, 90s, the death benefits are off the charts on these things, which obviously more than covers the initial need, which is good because we're accounting for things like inflation in this scenario and portfolio accumulation, which means these folks are going to be worth a lot more than $36 million in 30 years. So this death benefit amount could also be translating into some estate tax needs and other forms of coverage. So I'm gonna kind of wrap it there and summarize here real quick what we did to make things different for this client. But I really want to answer a lot of the questions that also came in to the presentation today. But again, we did some case evaluation. This started as a simple term conversion. The client the agent would have made about $10,000 bucks if he sold the GUL at the 7.5 million range just by increasing the benefit. He would have made about $52,000. But with this case evaluation, the way that we were able to structure it, the commission was well over $300,000. Point of sale support, like I said, we worked alongside the agent the entire way. We educated the client. We met with them face to face. We met with them over the phone several times. We helped them understand this transaction, and it really made it quite simple to close. Banking relationships and case design. We shopped the loan. We negotiated the deal. We got them a solid opportunity with one of the lenders, and it met all the needs and concerns that we had originally outlined with this particular case. And then underwriting, we got them a standard. That's such a big deal because it really made the numbers work out well. If we are in a table-rated scenario, these things get pretty hard to design, so it was really important that we were at standard. And I'll comment real quick on underwriting too. We're working on a case right now where the client's a smoker. Smoking rates, they can still work. It's just a little bit more difficult. We tend to net a little bit less death benefit, and perhaps we have to exit the loan a little bit later, but it is possible to get a smoker rate done. We just got to look at the age of the client. It all really boils down to the client's age, their health risk, and what we're able to find in the APSs and or in consulting with the client in order to create a good story for the underwriting team. So that's what really sets us apart. So at this point, I'm going to pause. Justin, I know there's some questions that we got before the presentation and some questions I'm sure that have just now come in. So you want to give everybody a minute or so and then we can address those?
Yeah, that sounds good. We got some, I got a few good questions here we can go through. And as Eric mentioned, if you have any, or if anything has come to mind over the course of this presentation and you didn't post it as it came to mind, please feel free to do so now. So Eric, I've got a couple of these here. Let's I'll throw the first one at you here. It says, how is the bank rate determined for interest, and how long can the rate be guaranteed for?
That's a really great question. So I mentioned actually in the presentation, I'll dig in a little bit more to interest rates because it is a big part of this whole scenario. So right now, interest rates are fixed from the bank either on 1-year LIBOR or 30-day LIBOR more often than not. Those are the popular ones. Excuse me. And I know there's conversation out there that LIBOR may be going away or is going away, but right now they're still using that as the underlying rate. We also have some banks that use like the 4-week Treasury, 4-week T-bill, which is a little bit lower, less volatile than the 30-day LIBOR. So it kind of depends on whether the bank's open to using that rate. So that's the part that we can't control, right? Those are the variable rates. So the bank selects one, and let's just, for example, say use 1-year LIBOR right now. It's just over 3%. So and just for easy math, let's call 1-year LIBOR 3% right now. So the bank's going to underwrite the client and determine a spread, and they're going to fix that spread. Across the board, most banks are fixing the spread or guaranteeing the spread for 5 years. In some cases, we can get that spread guaranteed for 7 years. I usually don't see it go much longer than that. And in most cases, the spreads start at a 200 basis point or 2% spread. So your all-in rate somewhere in around 5 or a little over 5 for most banks if you just kind of approach them naturally. That's where we come in. So we'll come in and we'll negotiate with the bank based on total volume that we do and a lot of other components there and how long-term our relationship is with that bank in order to get that spread down. So in this example, we got the spread down to 165 or 175, I think it was, and it was over a LIBOR rate. And we were able to get all the fees waived. So sometimes there's fees in addition to the interest rates, just depends on the bank. In this case, it was just pure interest and no prepayment penalty, which is really nice. So that's kind of the normal world out there. What we really try to do is push the spread down as low as we can and get to some of the lower, more volatile rates because we still don't see them performing. So like a 30-day LIBOR, you'll get a lower first-year initial rate. It'll create some volatility for you compared to the 1 year, but it still saves the client money up front. So if it's a bigger loan, we might be looking at a 30-day instead of a 1 year. So kind of a lot of different discussion points around the interest rate. But what's really curious right now in the marketplace is we're looking at fixed guaranteed rates. And there's two things that come into play there. Number one, credit swaps or rate swaps have always existed. So banks have to do essentially a swap to get a fixed rate. They have to basically index it so that they are able to project what they can get away with without losing money by fixing a rate for you. But in doing so, a lot of times they require the client to pay an upfront breakage fee, which means in exchange for me giving you a 5.25% rate guaranteed for 5 years, the client's got to come up with $200,000 extra on top of that. And a lot of times they'll let us roll that into the loan so the client doesn't feel it necessarily. But that is kind of like the traditional model. Well, now I'm in a lot of conversations, and I'm sure other people are with banks about getting a little bit more creative about fixed rates. Instead of a breakage fee, creating like a prepayment or a decelerating prepayment schedule or something along those lines in order to keep that collateral down, fixed or guarantee an interest rate to make it predictable, but make sure that the fixed rate still isn't something outlandish. We don't want a 6.5% rate or something like that because it's simply not going to be good for the client. So right now, you'll also see us come back with potential fixed rate options if that's something the client's looking for. I find it to be of interest to clients that are a little bit more sophisticated and have bigger transactions because they like the predictability of the rate, and we like the predictability of the rate. So that's kind of something new we're seeing on the interest rate universe right now is this ability to fix them and avoid a breakage fee. Sometimes there's other fees, like I said. Some banks will charge you an origination fee. Anything that they tell you that they're going to create in terms of a fee, if they want to roll it into the loan, that typically seems like an easy strategy. But you have to remember, anything you roll into the loan increases the amount of collateral required, and it increases that compounding effect on the interest long term. So it makes it tougher to exit, and it requires more collateral. So don't always assume that just rolling something in the loan is a better deal, and that's why we have so many banks, is we're looking for who's going to have the best deal.
Great. All right. We had another one here that just came in a little bit ago here. It says, if one of the partners has a health impairment, would the deal still be viable? And would you use a second to die policy?
That's a really good question. I've got a few of those cases right now that we're looking at. My answer is maybe. So the problem with second to die is it depends on the purpose of insurance to begin with. So if the purpose of the insurance was key man, well, that's not going to suffice because the key man dying just means the policy's dependent upon that spouse dying next, and that doesn't help the business at the time. Sometimes if it has to do with like deferred compensation or something where the cash value is going to be transferred to the insured, for the purpose of supplemental retirement income or something along those lines, then yeah, we can explore a survivorship policy. We just got to make sure that if we're using survivorship, it's still addressing the original need for the insurance, because the clients won't buy into it otherwise. But we have seen that happen before where we couldn't get one of the partners insurance, the other two were fine, and the deal was going to be completely soured, but we were able to get creative and basically design a key man type structure that had life insurance on the two insureds and a capitalization from their business for the other insured, and he just had more skin in the game when it came to the transaction because we couldn't buy life insurance on him. So where there's a will, there's a way when it comes to that stuff, but we can't assume that a second to die is actually the solution every time. It just really depends.
All right. Thanks, Eric. Let's see. Here's another one. It says, I already have my contracts direct with the carriers, but I'm interested in working with you on the financing. How does that work?
That's a good question. We would just look at a case split. So we just got to make sure that at the end of the day that we're making enough revenue to cover the work that's involved. Obviously a little bit of profit, because that's what we're all here to do is to run our businesses. But we would just look at a case split scenario that was lucrative enough for us to stay in the game. Because one thing that's really important here is this is not just a one-time transaction. I have to work with you and your client every single year during renewals. And so the typical loan horizon being 10 to 15 years, that means we have 10 to 15 years of work to do. So as long as we can, look at the case and agree on a case split that's going to be palatable for both parties, then we're open to that.
Great. Cool. Another one, similarly, if I've never done a case before, what is the commission split to have you help from start to finish?
Typically it's 15%. And that just depends on how much help we do. If I end up able to complete this transaction over the phone and not have to get on an airplane, I'll probably come down a little bit on the split. And it sounds like, well, that's, I prefer to be in front of my client. You'd be surprised. Most of these clients don't want to get together face to face. It's strange. I mean, some of them do, and I understand, and we're happy to do that. But we've been able to do a lot of these deals completely over the phone. And in that case, I might go from 15 to 10% on a case split.
Mm-hmm. Okay. It looks like we've got a couple more here. The next one here says, with your proprietary banking relationships, what is the actual financial difference in financing costs for a policy?
So it's going to be in I would say 3 different forms. The first one is lower interest rate spreads or lower fixed rates, just because we're negotiating and trying to leverage our relationship. So the cost savings in terms of the interest expense is one of the more obvious ones. The other would be the potential that we're negotiating away from personal guarantees, maybe because some clients just don't like them, or so that's sort of an intangible type of a thing, but it could make or break a deal. And or origination fees and some of the additional expenses. Sometimes, for example, here's a perfect scenario. We had a client who wanted to use their own bank, and the bank was managing the assets, so the bank was going to give the client a really good interest rate, but the bank didn't do premium financing, so they were nickel and diming us on documentation fees and legal fees. I mean, it was tens of thousands of dollars, and after it was all said and done, we were able to match that interest rate somewhere else and not have to deal with a bank that doesn't know what they're doing. So there was no documentation fee, and we saved the client tens of thousands of dollars. And so that's how you'll see it translate more often than not, is that particular type of approach in terms of the actual rates. And then also just making sure that we're evaluating the design of the policy. Sometimes it's not necessarily the right thing to buy $20 million of death benefit when we really only need to net, maybe 12. There could be a better way to structure it, that we're buying a little bit less death benefit to keep the total cost of the loan itself down. And other times we find it to be the opposite, right? We find that we actually need to buy a little bit more insurance to net the right amount of death benefit. So those are different ways that we evaluate a case in order to create real cost savings that make us different, I think, than sort of the average organization out there.
Great. And I've got one more here. It says, do I need a special E&O policy to do premium financing?
Really good question. You have to make sure that your E&O policy does not exclude premium finance. So make sure that you either contact your E&O carrier and or just read your policy. But some of those E&O policies actually do have a provision that exclude premium finance or other types of sort of leveraged insurance transactions. So if you need any help with that, you can talk to your marketing rep here at Brokers Alliance. We can help you find out if your policy is or is not going to cover that transaction. But absolutely make sure you check that, because that one can come down and bite you somewhere along the way there if your E&O coverage doesn't actually cover this transaction. Brokers Alliance's policy, obviously we have to have one too. Our policies do cover it. And we have a negotiated rate for E&O with our current carrier. So if you want to, if you find out that yours excludes it and you want to do this, we have a deal that we can hook you up with to maybe keep the cost down on a new carrier.
Great. Okay. Well, that kind of wraps up the Q&A portion. As I mentioned, we'll have an email going out here in the next day that includes a link to the recording of this as well. And if any questions come up from there, I'm sure we can funnel them in your way appropriately. Eric, any final thoughts or anything you'd like to say before we part ways here?
Yeah, I think I'll just, again, first of all, thank everybody for the time. I do appreciate it. And let's just have a discussion about a case. Like I said, you don't have to be an expert in this, or you can be an expert in this. Either way, I think there's benefit to talking about a case with us and see if it has legs, if it has opportunity. We're happy to run some illustrations to look at these things. Or if you're just wondering if you have a client in mind that may or may not qualify, there's different qualifiers. It's not just $5 million in net worth or $10 million in net worth. It depends on the client's age, the industry, the cash flow, their income. There's a lot of stuff. So if you got someone in mind, give us a call here. Let's talk about it and see if it's got legs.
Perfect. All right. Well, thanks so much, Eric. This was a really, really good masterclass. I think a lot of great information. I can tell. We had awesome engagement through this webinar. Everyone's hanging around. A lot of good questions. So really good stuff. Thank you again, Eric. Thanks for everybody for attending, and we'll see you next time.